Hello, everyone, and welcome to the Basepoint Wealth Investment Update and Outlook webinar. My name is Katie Ortgies, and I'm the Director of Operations and Chief Compliance Officer at Basepoint Wealth. We thank you for taking the time out of your busy schedules to join us. But before we get started, I have a few housekeeping announcements. To protect your privacy, all participants will remain muted for the entire webinar. For those of you joining us via the web conference, at the bottom of your screen, there is a Q&A icon. We will have a brief question and answer period at the end of this call. If you have a question during the presentation, please click the icon, type your question in the window, and click send. Whatever questions are not answered during the call, we are happy to address offline. If you are joining us via phone, or if you have a specific question about a holding in your portfolio or an aspect of your financial plan, we encourage you to contact your advisor directly, and they will be happy to answer your question. This webinar is being recorded. If we do have a brief disclosure slide, which you can review in further detail when the replay is made available. And with no further delay, I pass the mic to Alan Wallace and Landis Wiley to begin our presentation. Thank you.
Thank you, Katie. Welcome, everyone. I want to thank you for taking time out of your day to join us for today's investment update and market commentary. My name is Landis Wiley. I'm a partner and director of business development for Basepoint. I have the pleasure today of moderating this discussion with Alan Wallace, Chief Investment Officer of Basepoint Wealth. Alan is a founding partner of Basepoint and has been managing money since April of 2000, which for those of you with long memories, you would recognize that that was 1 month after the NASDAQ peaked. Alan resides in Marion, Iowa with his wife, Kate, also a founding partner and the president of Basepoint Wealth, his daughters, and a couple cats that fill his time in between reading about investment history. Without further ado here, I think we'll just go ahead and we'll kind of dive right into the topic du jour, which is what in the world is happening in today's investment environment. It's obviously been quite a experience and a roller coaster for many of us out there. So back in January, we conducted one of these market commentary sessions. And at the time, Alan highlighted 4 major themes that he was looking at heading into the year. Inflation and the impending actions by the Fed, a seemingly never-ending disconnect between market prices and fundamental valuations, the outsized impact that market cap weighting was having on market returns, and at the time, a correction that really hadn't hit headlines yet, but that came roaring to the forefront in the weeks that followed that call. So it seems like what was old is new again here. And Alan, I'm going to go ahead and kick this over to you to start off and maybe tell us a little bit about what you're seeing in the investment landscape right now.
Sure. Thanks, Landis. Let me start off by giving everyone a hearty good afternoon from Basepoint Wealth World Headquarters here in sunny Cedar Rapids, Iowa. It's a beautiful day outside. It's the kind of day that reminds you why you stick around in Iowa during the winter and the summer. So greetings to everyone, and good afternoon. So Landis, we are still looking at the Fed. The Fed is still the 800-pound gorilla. Now it's getting to the point where we're starting to wonder if whether or not they have as much power as we have supposed that they have up to this point. But monetary policy is still running the conversation. But now it's sort of the opposite of what we were looking at a year ago, in that we're worried that they're going to start reducing their balance sheet as opposed to increasing it. So what that does is it forces people out on the risk curve. So they go out into the open market, they buy assets, and that forces everyone else to sort of move out on the risk curve. I still don't think that is the driver of inflation. We'll talk about that as the presentation unfolds. And that leads us to the sort of next thing that we're looking at, which is the strength of the US dollar. The US dollar has been on a tear over the last 12 months, and that causes quite a bit of problems for other countries, especially emerging markets who have dollar-denominated debt. They have to go out into the open market and buy dollars with their local currency in order to pay the debts that they have. It's even causing trouble for some central banks. There's a little-known transfer going between the U.S. Federal Reserve and the Swiss National Bank of several billions of dollars over the past couple of weeks in order to help them maintain liquidity. Next, the correction in big tech is finally starting. We had Meta down 20+% yesterday. Amazon, last I checked, was down 10+% today. Apple is sort of stable, but we talked a little bit throughout the last year and a half about how market capitalization weighting is, how that impacts the S&P 500, because when you've got 35% of your assets stuck into the same 20 companies, when those companies start to correct, it really creates this feedback process by which the index will correct quickly. And so you think to yourself, who's indexed out there? It's the big pension funds, it's the big institutions. So as long as the big techs have sort of have maintained their price, those institutions haven't seen as much pain as they possibly will. But that's okay for us because we don't really own those things. We just added Google to our buy list over the last couple of weeks because it's starting to get to the point where we might look at it. And then the next thing is recession. So are we going to have a recession? I don't know. What I remember from being a young 19-year-old economics student was that a recession was defined as 2 consecutive quarters of negative GDP growth. Apparently, that lesson has been rescinded. And so now we just have to sit around and wait for someone else to tell us when it is a recession. So I have a difficult time making predictions in that type of environment. So looking at the sort of major economic and market drivers, we've talked a lot about inflation. This is the first period of inflation that we've had really in 40 years. There was a little bit of a spike during the 2008 period, but it was very, very quick and very transitory. And we have an investment industry that is populated by people who have little experience working in rising interest rate environments and accelerating inflation environments. So the Fed historically has responded to inflation by raising interest rates to try to slow down spending and to try to sort of curtail the activity in the economy in order to cool off any overheating. We've had a lot of talk about a soft landing over the past couple of years, and I would say that the odds of that are diminishing because of the sort of the delay that it took for the Fed to start reacting here. We went through this period of time where there was no inflation, then it was transitory inflation, and now it's, oh my gosh, there's inflation. So the odds of them turning this into some sort of deft soft landing is probably out the window at this point. And then there's a lot of economic impacts around the globe right now with all the geopolitical tensions and in currency fluctuations. As I sort of touched on the last slide, when currencies fluctuate, it creates tensions between governments, especially when you hold the reserve currency. The US dollar is still the major reserve currency, and that sort of creates competing tendencies between different governments. So I don't know how many of you are familiar with the old Donald Rumsfeld quote. He was the director of Defense Department during the Bush administration, but he had this thing about known knowns and known unknowns and all these other things. And so right now we've got a few known unknowns. In other words, we know about the risk, but we don't know what's going to happen. And it's not really those that get you in the end. It's the unknown unknowns. But unfortunately, I don't have a slide for that because I don't know any of them. But so we've got the Russia-Ukraine conflict going on, which we're heavily involved in, for better or for worse. We don't really get into political commentary, but there are some risks there. It's the first time I can remember since I was a child that people are talking about a nuclear war. So not that I think that that's a high probability event, but we put it into our fat tail calculation and start to ask ourselves what would happen. The next thing is China. There are some indications that the Russia invasion of Ukraine is giving China sort of a playbook for what happens when they decide to take Taiwan back. And the big thing for us there is that that's where all of our chips are manufactured. And so if China decided to take over the majority of our chip manufacturing capabilities, it would be detrimental to our economy. There are already chip shortages out there. I heard a tale about defense contractors buying washing machines in order to pull chips out of them to put into missiles. I don't know about the truth of that rumor, but it's pretty terrifying if that's what's actually happening. The next thing that I really want to talk about is the European energy crisis. We do have some exposure to European equities. They're significantly cheaper than U.S. equities. It gives us hedges against a few things, so I don't really want to cut that exposure just because it might be volatile. But it's going to be a long, cold winter in Europe. The cost of heating homes is growing exponentially. There are estimates that many restaurants in the UK will shut down because they don't have subsidies for business utilities, and people are getting £10,000 utility bills. There's lines miles long in Poland to buy coal. Germany is harvesting ancient historic forests in order to burn wood for the winter. So things in Europe are looking bleak heading into the winter. One little known fact is that there are shortages of diesel fuel in the US. We're down to less than 30 days supply there. And so there's a lot of talk about, well, why don't we just release more oil from the Strategic Petroleum Reserve? And the problem is that it's not oil supply that's hindering us here. It's refining capacity. You know, we haven't built a new refinery in the US in decades, and there's no indication that we're going to. So it takes a long time to build those stocks back up. And then there are certain political jurisdictions, states on the West Coast that regulate their fuel differently than the rest of the country. And so special batches have to be made in order to serve those places. And it becomes harder to deliver under those requirements when you run into capacity shortages. So when you have California has very stringent regulations on fuel production. And so when a lot of the goods are arriving in Newport Beach and they have to be trucked across the state, you have a shortage of a commodity that restrictions are preventing from being produced, it creates sort of a bad situation. And then finally, the midterm elections. Right now, the predictions are that the Republicans will win the House and that the Democrats will either maintain the Senate or the Republicans will earn a very slight majority. And with a Democratic president, that sort of hints at gridlock in Washington again, which under certain circumstances can be good. And so I wouldn't expect anything big to come out of Washington if that is the situation going forward. So just taking a look at the current environment and why this correction has seemed so painful. Typically, we hold bonds as a counteraction against equity declines. And this chart is very busy, but what you see on it is all the equity declines going back to 1962. And you'll see that bonds have almost always performed better than or even had positive returns during a period of equity declines. But what you'll see right here is this period of time that we're in, bonds are actually underperforming equities. And that has sort of thrown the 60-40 portfolio into a tailspin, because you've held bonds traditionally to protect assets on the way down. And when you have a period of rising interest rates in concurrence with an equity decline, you can get some of the things that we've seen, which are portfolios that have significant downside performance. And I want to sort of start with this so that everyone keeps this in mind when we're talking about why our performance has been so different than the average portfolio out there, because this is something that we've been talking about for years. It's not higher than average intelligence that led us to the fact that if interest rates rise, bonds are going to outperform significantly. And so we've had to be patient for years now in order to avoid the decline that we're looking at.
Thanks, Alan. And I know you mentioned this in your comments there to kick us off, but something you've talked about often and have referenced in your writing as well is that few investors and even fewer money managers today were alive the last time we faced high inflation, rising interest rates, and challenging equity valuations like we're experiencing now. And like you just pointed out on that last slide, you've long emphasized the need to identify principles in investing and to stick to them, even when the markets writ large maybe favored other ideas. So let's talk a little bit. How is your team working to position client assets to address the challenges that you highlighted?
Sure. Before I start on that, I just want to get a couple terms into an agreed upon state here. So we define principles as fundamental truths that are meant to guide us through all environments. They're not mathematically based. They're not based on current circumstances. They are truths that we see as eternal, and they lead us to develop our processes, which are systems that are derived from our principles that are meant to guide us through the current environment. So our processes are flexible. They change based on what's going on in the world. Our principles are fundamental, and they don't change over time. So our principles, which I've talked about extensively, I don't want to bore you by reading them all to you, but there are 7 principles, and they've been derived from a look at the investment literature, especially the investment literature before 1952, which is when Markowitz writes his treatise on modern portfolio theory. The methodology for investing money before 1952 had lasted for hundreds of years, and we feel like there's a lot of truth there, and we've so far received good results by following these principles. So there's a lot of confusion when we talk about what we do. We call ourselves wealth managers, and the guy down the street might call himself a wealth manager, and the place across the street might say that they're an asset manager. So we're trying to break this down into fundamental components so that when we talk about different ways to manage money, it's clear what perspective we're coming from. So we define asset management as the process for selecting securities to build an investment vehicle. So your fund manager practices asset management. He doesn't need to know your name. He doesn't need to know your goals. He knows that he has a mandate to buy large cap value securities, and that is his mandate or her mandate, and that's an asset manager. A portfolio manager is someone who provides a process for allocating different investment vehicles to build a portfolio. So you might get into things like risk tolerance. There are know the client rules that you have to follow. They may know you, they may know how much money you need on a monthly basis, but basically they take a stock allocation, they do security selection, and they build a portfolio for you. Wealth management is an overarching process, and it includes different phases, and portfolio management is one sector of wealth management. Our wealth management process has three stages: the planning, the execution, and the feedback stage. So here is a scary chart of our current wealth management process. It has the 3 different phases, and then each of those have sub phases. What we're going to talk about today are areas of concern from the asset allocation stage, the investment selection stage, and then we're also going to talk a little bit about performance evaluation. So just I want to couch this by letting you know that we're talking about small sections of an overarching process, and the areas that we think are important in order to sort of evaluate your portfolio and where you're at. So our current asset allocation, this assumes an advisor has already gone through the planning and the investment policy stages with you. These are the 5 allocations that we would put an investor into, with modifications, of course, based on the client's needs. You'll see first and foremost that we're holding an excessive amount of cash right now. That has come down a little bit over last year. At the peak of the market last year, we had more cash than we're holding right now. You'll also see that our fixed income position is lower than it would typically be. Equities are lower than they would normally be, and our alternatives are higher than they would normally be. And that was due to the fact that there were negative real interest rates, which have since gone positive. So we have been sort of reducing alternative exposure and increasing equity exposure over the last year. So how have these allocations sort of played out over the past 12 months, or at least year to date? Our excessive positions in cash have really rewarded our patience. We were earning 0.01% on cash 12 months ago. Now we're earning 2.55% on cash. And so we've also not seen declines. So even anything on the fixed income side, where rising yields have reduced the prices significantly. I saw the other day that the 20-year bond, we're down 25 to 30% year to date, which is a significant decline. Our equities have declined slightly. Our value equities have actually performed really well. Some of our better performing accounts are 100% equity on the value side. If we include any growth equities or international equities, then we start to see negative returns. But we've also had really high exposure to natural resources, which have been our best performer this year. I think our natural resources section is up about 40% year to date, which has really helped return significantly. And then finally, alternatives, which are things that are not stocks or bonds or cash. In this area, we have merger arbitrage, we have long short portfolio, we've got some commodities and precious metals. So as real rates have gone higher, it's lessened the attractiveness of alternatives. But we still do need exposure because we can't extrapolate the present into the future and expect that what's currently happening is going to continue happening in the future. We still need to make sure that we are covered under a wide range of contingencies of future events. Let's talk a little bit about performance evaluation. So there are three modules in the performance evaluation. There's performance measurement, there's performance attribution, there's performance appraisal. And this is sort of how we look at our investment policy to make sure that it is performing the way that we want it to perform. And it helps us identify strengths and weaknesses in your overall portfolio. So if we look at benchmark return, you'll see that a 60-40 portfolio, which is sort of the standard vanilla recommendation for a person that doesn't want to spend much time on it. This would be the Lehman Brothers Aggregate Bond Fund and the S&P 500, just mixed into a portfolio of 60% stocks and 40% bonds. Year to date, as the date I printed this, which was October 25th, down 19.98% year to date. That's a significant decline, especially when you have 40% in bonds. You can sort of see at the bottom there what the indexes have done. The Dow Jones, which is a little bit more similar to what we would invest in, is down about 11.5. The NASDAQ has had a significant decline due to its exposure of technology and growth stocks. We can also look at the bond returns. You can see that the broad bond market's down 16%. U.S. corporates are down 19%, and the long-term bonds, which is just unfathomable, is down 31.76%. But our results have been significantly different than what a broad index would have seen. So our firm, as of 10/25, the total assets of Basepoint are down 10.6%. That compares to a 60/40 at 19.98, and a class blended benchmark, which sort of highlights our security selection, of 11.1. So a class blended benchmark takes our allocation. So based on asset allocation, we've outperformed by about 9%. But taking a class blended approach, we have outperformed by about 0.5%. Keep in mind, that just takes a group of indexes that layer over what we're holding and removes all the costs. So what that tells you is that we have outperformed by 50 basis points, even after costs, both at the fund level, the trading level, and at the advisory fee level. Here is a distribution of returns, just so we can sort of see where the returns lie. So as of October 25th, the total assets at Basepoint were down 10.6. Benchmark was minus 11.1. And if you look here, you can see how the accounts are sort of distributed. There's a nice normal distribution that sort of shows you how we've increased equity exposure. It has actually helped returns. As bond exposure has increased, it has hurt returns. But the majority of the accounts sort of fall in this minus 12 to minus 8 range. There are some out here in the tails. Most of these would be just all stock accounts. Some of these over here are highly conservative accounts that have all bonds, or some of them hold a lot of tech stocks that clients brought from other firms. That's what would get the returns out into these areas. And then if we look at performance relative to benchmark, you'll see that the majority of our accounts are outperforming their benchmarks by 2 to 4%. We have a couple that are underperforming benchmarks over here, and then but on the whole, the majority of our accounts are outperforming not only the asset allocation, but also this on the security selection side. So talking about asset allocation outperformance, which is about 900 basis points, and then also talking about security selection outperformance, which is about 50 basis points year to date, even after fees. It's important to note that we track investments in over 25 different asset classes. We don't hold all those at the same time, but we have a list of securities that we would purchase in all the asset classes. So let's say we decided next month we wanted to add floating rate bonds to our portfolio because the spreads have expanded and the default cycle has started, and we feel like it's a good time to add those. We already have done the work to have the fund available. And it's not as simple as just looking at performance. We went through a lengthy process of calling portfolio managers, of finding out what they actually hold. You know, a lot of these, just because they're classified as a certain asset class, doesn't mean that they're even following that strategy. When we did our security selection on inflation-adjusted bonds, we found that some of them didn't buy inflation-adjusted bonds at all. They just held treasuries in the hopes that the inflation premium inside the treasury bond would decline. We found that some of them had portfolios of high-yield bonds with inflation swaps on top of them. So there's a lot of work that goes into making sure not only that the fund is pure to its asset class, but that it also holds the sort of things that we would want to hold when using that investment. And it's also important to note that we don't change funds often. Most of the funds that we currently use, we've been using for 8+ years. Some of them have been added over the last few years because funds close or they get too big or management changes, but that's typically what causes us to change the fund. So our investment universe is huge. There are 7,600 mutual funds on the Fidelity platform. There's 130,000 available globally, which we are not limited to Fidelity. We can use any custodian we want. There's almost 12,000 individual stocks in the US. There's 43,000 globally. We can use 46 different exchanges. There are 2,600 ETFs, 600 preferred stocks, 225 real estate investment trusts, and then all the bonds, all the private investments, currencies, precious metals, cryptocurrency, annuities. So we are looking at a gigantic universe of different investments that are available. So this is a little bit busy, but it just kind of shows you our security selection over the last few years. And so let me sort of explain what's going on here. If you see a red plus, that means that that's a fund that we currently use. If there's no plus, it's just on our buy list for if we would ever add a certain security. And over here is the rank of that fund out of their entire universe of comparable funds. So for instance, when you look at this Pear Tree International Small Cap, there are 23 other international small cap value funds. Pear Tree is the best out of that over the last 10 years. SME Value is the best out of the last 10 years. This fund is number 2 out of 50. This fund is number 7 out of 20. And as you can see going down, the majority of our funds, even the ones that we're not currently using, are in the top 10% or the top or the top quarter of their universe. So our SMED is the only fund in the U.S. large cap value space that has outperformed the S&P 500 for the last 10 years. It's the top performer. It's our largest fund holding. Largest equity fund holding. And our clients have held that fund since at least 2014, and I think going back as far as 2012. So we have received quite a bit of benefit, not only from asset allocation in keeping our cash up and our equity exposure limited to the value side, but also our security selection has also added significant value to our investment process.
Thanks for that, Alan. I think it's always insightful to hear your thoughts on how you and your team approach portfolio construction and the management process. And I think it's also interesting for folks on the call today to kind of get a sense of how there's a systematic process that you and your team follow and that Basepoint in general follows, but how the individualization down to specific individual clients really does serve to benefit and customize portfolios to match the outcomes that our clients are looking for. As we look ahead, I guess our next thing would be, what are some key themes that you're watching, particularly with respect to impacts on fixed income and equities? Those seem to be kind of the hot button issues based on what you've shared here so far.
Well, the most important factor that we're looking at right now is interest rates are sort of a double-edged sword. As rates rise, it hurts people that are holding existing bonds, but it makes bonds more attractive for us to purchase. So what we're doing is we are actively moving money from cash over to shorter term bonds. We're focusing on the 2 to 3 year treasury market. which is getting us in the 4.5% range right now compared to 0%. And we'll look at that actually in another slide. But so interest rates are creating opportunities and challenges because they do harm us on the equity side to a certain extent. The next thing is that fixed income is actually becoming a viable asset. So for the last decade or so, it's been almost impossible to manage a portfolio that gives a client the returns that they need while adding fixed income, unless you're moving really far out on the risk curve. So that's been a struggle that we've had that is sort of starting to decline, and we're starting to dust off our fixed income management books in order to start adding not only treasuries but corporates and some other more esoteric areas of fixed income like preferred stocks and convertibles and things like that. So your return dependence on equities is declining as fixed income becomes more viable. Also, equity valuations are becoming cheaper, especially on the growth side. The issue is that as rates rise, that relative performance or relative valuation it looks worse. So we'll talk about that a little bit on a couple of equity slides. But even though equity valuations have come down, the fact that rates have come up have made the current pricing not as attractive as it was 12 months ago. And then also our alternatives portfolios, which are different strategies that we use, and then also gold and silver are continuing to be subject to the U.S. dollar fluctuations. As the dollar strengthens, the price of our commodities continues to be volatile on the downside. This is just a view to let you know how different the fixed income market looks today. The blue line is are the yields on fixed income in 2021. The orange line is the yield on income on fixed income in 2022. And as you can see, there has been a gigantic spike in the yield available. And not only that, but the yield curve has flattened and twisted. So especially in the treasury market. So you'll see that the 10-year is actually lower than the 3-year, but the 20-year is higher. So we've had some twisting in the yield curve, and then we've also had significant increases in the yield curve. What we're looking for is for the yield curve to steepen, which means that the longer term bonds start to pay more than the shorter term bonds. And that tells you that the economy is a little bit healthier. So once we can start to get 5 to 6% on longer term bonds, we might start using those. And just with the caveat that you're going to see volatility, but your return over the holding period is going to be fixed. So we have to sort of get out of this average annual return derby that we're in and think about holding period returns and thinking about reaching lifetime goals instead of just trying to shoot the lights out 12 months at a time. So just a highlight here on how equity valuations have changed since 2021. This is data from September of 2021 versus 2022. You'll see that last year there were 11 equities that met our criteria, and now we're up to 38. The portfolio discount, which is what we think you can buy it for as a discount to $1. So we're able to buy it for 75 cents a year ago, and now we're getting closer to 57 cents on the dollar. The earnings yield has increased from 6.34 to 9.02. Our dividend yield has doubled, and you can see that the treasury yields have tripled. So that's what I mean when I say that the current earnings yield is not as attractive in relationship to the treasury yield. Remember that treasuries are substitutes for equities, and if we could get 9% on a treasury and 9% on an equity, we would be silly to choose the equity because it contains significant risk of fluctuation in the future. So we expect to be paid more in order to take on that risk, and right now we're getting about double, whereas we were getting about 3 times more in 2021. So we need to be careful not to jump all in at this point and sort of wait for a little bit better premium. And what I mean by earnings yield is the earnings per share divided by the share price. So on a $100 stock, if they're earning $10 per share, that's a 10% earnings yield. And the reason that's important is because that's the cash that's coming into the company. If you had a savings account that was growing at 5% a year, then it would compound at that rate. So we take a look at earnings because it lets us know how much money is being reinvested into the company on any given year. And we expect management that's going to deploy that capital in a manner that benefits shareholders. And so that's why management evaluation is so important too, because we're trying to buy things with high earnings yields, and therefore we want management that's going to be responsible for those earnings.
Great, thanks, Alan. So I think the general sense here is that the landscape for investors is broadening, which certainly can be a positive. But there's obviously quite a few traps that still exist out there and remain a key focus of you and your team. So as we kind of head into the final stretch of our discussion here, can you give us some thoughts on how your investment process has played out relative to some of the bigger market and economic themes that have dominated so far in 2022? And then maybe give us a little insight into what you're focused on in the coming months for Basepoint's clients.
Sure. So as far as the last year is concerned, the major benefiting factors were our avoidance of overvalued equities. We were almost exclusively value stocks with earnings and revenues that could be quantified and a fair value can be calculated. Most of the major declines that have happened have been in either technology or communication stocks that were highly overvalued, which we tried to highlight 12 months ago. And then also keeping the duration almost zero on our fixed income. So we have had some declines in our fixed income portfolios, but they're about half, or in some cases a third of what a general bond fund would have received. And then we had a significant amount of cash that we've been moving over into treasury bonds to increase that yield from 2.55 to 4.5. So we're almost doubling the yield that we're getting on current cash. The next thing is that so some people were disappointed last year that we underperformed because the market was sort of screaming higher. But it's important to note that at this point, the outperformance of the market in 2021 has been more than erased in 2022. So our patience and our ability to watch our neighbors get temporarily richer has rewarded us this year. We started adding energy exposure at the end of 2021. That's been our best performer year to date, and that was simply based on the fact that Europe is sort of a basket case. We're also trying to move to electric cars, and Bitcoin is a big burden on the energy grid, and we haven't been rewarding companies to explore for new sources of energy. And so taking all those things, we thought, well, let's add some exposure. And that exposure is up 43% year to date. So with 5% of the portfolio in energy and with a 43% return, that's a significant buffer for some of the returns that we've seen. The strength of the dollar does continue to weigh on our commodity prices, but that doesn't necessarily have to continue. We want to have some investments that benefit if that trend reverses, that are still going to do well over time. And what we find from commodities, especially gold and silver, is that they do protect against inflation, but not on a short-term basis. They protect from inflation on a long-term basis, and these are long-term portfolios. So over the next decade, we should receive a benefit in an inflation hedge from holding those securities. In the short term, though, it can be painful to watch those things hop up and down because they do fluctuate quite a bit on a short-term basis. And then our huge positions in cash and cash alternatives have really been our star performers behind oil and energy, but they're now starting to actually generate yield. So what used to pay $10 is now paying $2,500 sitting in cash with zero downside, zero duration, and no future risk. So that's sort of a summary of where we've been so far this year. So looking ahead, my crystal ball is not quite as clear when I look at the future as it is when I look at the past, but just a few factors that need to be highlighted and need to be monitored. If inflation continues to rise, then it may harm our fixed income positions. That's why we're continuing to keep our duration and our maturity short, and we're keeping we're still keeping high cash positions in the event that there's continued future inflation. If nominal interest rates continue to increase, then that will hurt both our bond and our stock positions. But rising real rates will benefit our cash. So cash will respond to rising real rates. That's what we've seen over the last 12 months. So we should continue to see our cash rates rise. Some of you who were adults in the 80s probably remember getting 12% on your savings account. Not predicting that happen here, but if real rates rose, then that's what we would see. If the dollar continues to strengthen, it's going to hurt our international positions, including emerging markets, and it's also going to cause our commodities positions to continue to be volatile. But again, we don't know for certain that that's going to happen. So if the dollar does weaken, then we have positions that counteract that. And it's important to note that we've printed trillions of dollars in cash over the last couple of years, which is one of the major catalysts for the inflation that we're seeing on the good side. So if you look back at the Continental Congress, if you look back at the Confederacy and the Civil War, if you look at France in the 1700s, after periods of time where fiat currencies have been printed in great amounts, it has eventually led to some sort of decline in that currency. And so we want to protect against that risk, because even though that may eventually happen, we don't know the timing. It could take 30 or 40 years. From the time John Law went to France till the time Louis XVI was beheaded, it was something like 80 or 90 years. So the market can remain irrational far longer than we can remain solvent. So we have to just continue covering ourselves for multiple contingencies and try not to predict the future or the timing of the future. If there's a US-based recession, our domestic stocks will continue to have headwinds. And then finally, the big problem here is that profit margins are at all-time highs. And profit margins tend to be a mean reverting statistic. And so if profit margins do start to decline, especially when we buy based on earnings yield, that will be a headwind for us. So we need to be careful that we continue to buy companies that have pricing power and that have goods that are necessary and that have economic moats, so that they can continue to grow revenues and maintain profit margins so that we don't have a correction in the equities that we hold. So here is our plan, what we intend to do. We intend to continue to allocate excess cash. So if fixed income yields remain elevated, we will continue to move money from cash accounts over to fixed income accounts. We take on a little bit of duration risk, but we can get significantly higher yields. If we hold those bonds to maturity, then we expect to get all of our money back, barring a credit default. But we, at the current time, are not taking credit risk. We're taking only interest rate risk. We will continue to allocate cash to equities if prices continue to decline. If those earnings yields continue to rise in relation to the yields that we can get on treasuries, we'll commit more money to equities, especially if we do have a recession and we get through that recession. That is the best time to buy more equities. We will move out on the yield curve if it does start to steepen and it offers future higher returns. That will increase short-term volatility. But again, if we hold those bonds to maturity, we expect to receive all of our money back. So we have to get away from this religion of average annual returns and start thinking about portfolio returns and how much closer are we getting to reaching our goals, which is to have our money last for the rest of our life. We may look to add credit risk if credit spreads widen. Credit spreads have been ridiculously tight. So what that means is we're not getting paid to take on the risk of a corporation that doesn't have taxing authority. So we're continuing to limit credit risk so that we only have interest rate risk. The more that we find individual stocks that meet our criteria for investment, the more we'll lean on our own internal asset management as opposed to external asset management. We're going to continue to reallocate your alternatives and reduce the total exposure as real rates rise. Increasing real rates are difficult for some of our alternative categories. And then growth stocks are starting to get cheaper. I think we added Google to our list of buys in the last week. And so as the price of what used to be called growth stocks becomes more reasonable, we will definitely start to add those, and we have begun that process. And then we will continue to be defensive against inflation, even though we're not trying to predict what will happen. We feel like the risk of inflation is worse than the risk of not inflation. So we want to make sure that we don't take on catastrophic risk by making future predictions that are coin flips. And then we'll also expand our fixed income universe. If the default cycle begins, we might start to add things like high yield bonds, floating rate bonds, maybe mortgage securities, which we have a little exposure to, but not much. So sort of our thoughts heading into 2023. So far, we feel like our positioning has been right. We were early, but if you're late to this party, you lose half your money. If you're early, the neighbor gets to tell you that he did better than you. So those don't seem like equal distribution consequences to us. 2022 is sort of what we expected to have happen in 2021. We had that blow off top in 2021, so we had to sit around and watch the market scream higher. We still did okay. We underperformed a little bit, but most of our clients still met their return requirements. So that's more important to us than the appearance of high temporary returns. And as I said earlier, we don't have a crystal ball, but we are ready to be flexible and to respond to circumstances as they change.
Great, thanks for all that, Alan. With that, I'm sure there's probably some questions floating around in our audience out there. And as we're fast approaching the 1 o'clock hour, I want to go ahead and transition over into our Q&A session. Before I do that, just a few reminders from Katie's comments earlier for those that are participating. You can submit questions using the Q&A feature at the bottom of your screen in Zoom. Because of client privacy requirements, we cannot address client-specific or account-specific questions in this forum. However, we do encourage and welcome questions about your personal account, and we'll address them individually outside the webinar. We'd encourage you to reach out to your advisor if there's anything specific to an individual account. So we'll allow a few minutes here for some questions to come in and go from there. I did get a couple here, Alan, that I can kick this off with. And it has to do with the cash allocation, the cash position that you referenced several times. And the question is, it looks like Basepoint continues to carry a lot of cash in the allocations. At what point will a market correction meet the criteria that would cause you, Basepoint, to put more cash into the markets?
Sure. That is a question of alternatives. So if we feel like the risk of buying a security is adequately compensated by the return of holding that security, then we will definitely make that switch. As fixed income yields continue to rise, we may want to lock in higher rates. And as equity prices continue to drop, we may want to take on equity exposure. But there's no magic number, because we're looking at a bunch of different interactions. We're looking at inflation, interacting with interest rates, interacting with currency, volatility, interacting with geopolitical concerns. So there's no magic number. It's just based on the alternatives available to us. And we also may buy a security and then decide that cash again becomes a better alternative. That's why our allocations are flexible and why we rebalance accounts.
Great, thanks. I've got another one coming in here, and it's one that pops up quite frequently. Maybe not so much in the last couple of months, but throughout much of 2021 and into 2022, we heard a lot about. Would Basepoint consider the use of Bitcoin or other cryptocurrencies as a hedge for inflation, particularly if the SEC were to approve these for wider spread retail use?
At the current time, we have no anticipation of utilizing any sort of cryptocurrency. There is no methodology for us to adequately value them, so they're purely speculative. They don't adequately function as a store of value. They're way too volatile for that. They're a poor means of exchange because they're expensive to transact in, and it's difficult to have a unit of account that is so volatile. So we don't think that it functions as money. That doesn't mean it's not going to be significantly volatile and go up quite a bit over time. But again, there are no called strikes in investing. So we are going to stick to the things that we understand. And, we feel like there are other areas of investing that can get us higher, safer, more consistent returns than we would get by adding cryptocurrency to our portfolios.
Perfect. Next question. You mentioned the strengthening of the dollar over the past year, and I'll kind of add to this question. So the question is, do you anticipate the dollar to weaken in the next year? And Alan, maybe you could couch that with a little bit about, what are the driving factors that cause the dollar to strengthen and weaken relative to global currencies?
Sure. In the current environment, now you can go back to your economics textbook and read a bunch of theories on what causes currency fluctuations. But in the present moment, I think it's supply and demand, especially since the dollar is a reserve currency. You've seen as interest rates have risen, there's been a high demand for dollars. If you're sitting in a country that has a 0.1% yield on your 20-year bond, but you can get 4.5 over here, you're going to sell your bond, sell your currency, buy dollars and buy bonds. That's a mechanism. That's one mechanism by which currencies fluctuate. There's a lot of other things that go on with central banks that are a little bit esoteric and above the grade level of this conversation. But needless to say, we don't try to predict currency fluctuations. What we try to do is position ourselves so that they're not overly harmful for us. We do have precious metals exposure, which should benefit from a declining dollar. We also have international equity exposure, which has been extremely punished by the strengthening dollar, and we would hope that process would reverse during a period of declining dollar. It's important to note we don't hedge currency transactions. They sort of neutralize over time. So anytime I've seen a portfolio that has a currency hedge overlay, you just end up paying for something that you don't really need, because unless a currency sort of implodes, they just sort of tend to move back and forth over time. So and that's the thing that we're afraid of here, right? We've printed so much money over the last few years, and so our fear of losing reserve status, which we don't think is a highly likely scenario. We think it's on our list of possible things, and something that we don't mind having a little bit of exposure to protect against.
Thanks, Alan. You mentioned in there just briefly a reference to commodities like gold and silver. So there was a question that came in. What would maybe be a driving factor that would cause the price of gold to increase, and alongside that, I guess, would be silver?
Sure. So let me unpackage that. The most important thing that would cause the precious metals to increase would be a declining dollar or decreasing real interest rates. Those two things should cause immediate impact on the precious metals market. If I look at the recent past, those are the things that have sort of driven those two commodities. Now, it's important to note that gold is almost purely a precious metal. There are a few industrial uses for it, but the majority of it is just because it's pretty. Silver, on the other hand, is a significant industrial metal as well. So if you're heading into a recession, silver is going to decline more than gold because the industrial component of the metal is more significant than on the gold side. So what we look at is this thing called the gold-silver ratio. So in other words, how much silver can you buy for an ounce of gold? And right now, the gold-silver ratio is about 85. When we added silver, it was 105. So that tells us that spread has contracted, which we have benefited slightly from, even though overall the two commodities have gone down in price. Historically, if you go back to the Roman times, that ratio was closer to 15 to 17. And the reason for that is because there's about 17 times more silver in the ground than there is gold. Things were much simpler back then. So we continue to hold silver because the gold to silver ratio is so expanded. Now, again, just because certain statistics are mean reverting doesn't mean that is going to last forever. But over 5,000 plus years, that ratio has been relatively consistent. So we continue to hold silver, and we also hold gold. And both of those are hedges against declining real rates and a weakening dollar.
Great, thanks. One thing, obviously, kind of front and center for a lot of folks and on the news frequently here is actions of the Federal Reserve. Obviously, they've taken some pretty dramatic steps in recent meetings with 0.75% increases. Discussion right now is in the meeting coming up, I believe, next week. Will they go with another 0.75 percentage point hike, or might we be facing an inevitable pivot where they start to reduce that? To use the proverbial crystal ball, what's your crystal ball suggesting might happen with Fed action over the next several months?
So that's a psychology question, not an economics question. It depends on how much Powell continues to want to channel Paul Volcker, who went down in history as a hero for his staunch defense of our economy against inflation in the 80s. So there have been comparisons made, and if Powell feels like he wants to be Paul Volcker, then he'll continue to be tough and continue to raise rates. If the political pressure gets to him, then he may decide to reduce rates. This is a matter of psychology, not a matter of economics. So I can't really tell you. Newton said I can calculate the movements of the heavens, but I cannot calculate the madness of men. And I'm sympathetic to Newton in that regard. But what we continue to do is be positioned in a way that isn't overly harmed by either outcome. Time will tell. But as far as trying to predict what Chairman Powell will do when under pressure, I don't know him well enough to make that assessment.
Great, thanks. So I've got one more question here that we'll get in before we wrap up here right at 1. Obviously, the last couple of weeks, there's been a little bit of a recovery in some of the markets, particularly in the Dow. And so I'm kind of pulling together a couple different pieces of the question. But the question would be, do you get a sense that perhaps the markets have found their bottom, or that it may be near? And does it, by extension, if that were to be true, is there any fear of missing out should the quote unquote bottom be in, and maybe things are turning and headed the other direction?
So I don't know what the market's going to do. It's either going to go up or down, and there's a small chance it's going to stay the same. I'd like to take credit for that quote, but that's what JP Morgan would tell people when they asked him what the market would do. But what we can look at is valuation. And what I can tell you is that that markets in general have become more reasonably valued, but with the rise in interest rates, they're not a compelling value as they would have been if they were at this level 12 months ago. So there's no fear of missing out here, because that is the most dangerous emotion in investing. These equity returns are not coupons that you clip and put in your pocket that you can spend someday. They're transitory, they're volatile, they fluctuate. The market could go up double from here, and then it can be cut in half again later. So we can't spend temporary returns. So we don't worry about missing a bottom. But at the same time, we have significant equity exposure. We're also adding more fixed income exposure. So if the market goes up, we're going to benefit significantly from that. Keep in mind, most of our clients require somewhere between a 4 and a 6% rate of return to have their money last the rest of their lives. It would be dangerous of us to say we're going to go all in at any point, because none of our clients need to take that type of risk. But we will continue to follow our principles. They've gotten us to this point. We have moved in and out of equities based on valuation twice since 2020, and it served us well, other than a slight period of time of underperformance last year, which we've more than made up for. We will continue to follow our principles, and if our principles state that now is the time to increase your equity exposure back to our baseline, which would be closer to 60% on a moderate portfolio, then we will do that. But we are adding more equity exposure right now, because there is more value in the market than there was 12 months ago. So what we won't do is go from 40% equity exposure to 60% equity exposure overnight. We're trying to buy companies that make money by earning income and reinvesting in their business and becoming more valuable over time. Not because someone has decided that they want to pay us more for $1 of earnings than they paid us last week.
Perfect. Thanks, Alan. And with that, since we're coming up here on 1 o'clock, I'm going to conclude our portion of this, and I will go ahead and hand the mic back over to Katie to wrap us up.
Thanks so much, Landis. I was having trouble finding my unmute button. But thank you so much for attending the Basepoint Wealth Investment Update and Outlook webinar. If you have any questions, please contact your advisor directly or call us at 319-826-1898. Have a great afternoon.